Foster's shareholders are expected to approve a demerger of the company's beer and wine divisions when they meet in Melbourne tomorrow. Since entering into the wine industry over a decade ago, Foster's wine division has been an albatross around the company's neck with a series of losses. And with global players circling, the split is expected to leave both businesses open for a takeover, as Emily Stewart reports.
The Foster's Group is close to recovering from its big financial hangover caused by its foray into the wine business.
The indications are that the institutional shareholders here will go ahead, so it does seem that this is very likely to pass tomorrow.
There's no real reason at the moment that the market or shareholders shouldn't approve it, and the board themselves have encouraged shareholders to do so.
The deal offers 1 share in Treasury Wine Estates for every 3 Foster's shares. For it to pass, 50% of shareholders who own at least 75% of the company's stock must support the move. But analysts say there could be some criticism of the $151 million cost and the $10 million payout to departing CEO Ian Johnson.
There are reasons for this cost, remembering that $26 million of that, for example, relates to the unwinding of foreign exchange hedges which are necessary to restructure the debt of the group.
Foster's first wine acquisition was the purchase of Mildura Blas in 1996. Over the next decade, its wine portfolio grew to 50 brands. But the wine business hasn't performed well because of the grape glut and the high Aussie dollar, and has continuously dragged down the Foster's Group financial results.
That wine glut that eventuated in the early 2000s meant that the business has been facing very tough trading conditions since then.
Analysts say the high Australian dollar will continue to hamper Treasury Wine Estates' earnings as it forges ahead as a standalone entity. But UBS Investment Research says net profit after tax is expected to grow in the next 3 years. And the beer division is expected to go from strength to strength, and UBS says it will represent a predictable, defensive, steady yield stock. And with the split, both businesses will make more attractive takeover targets. Last year, US private equity investor Cerberus made an unsuccessful approach for the wine division for more than $2 billion.
I think we're looking at the global players here. The Treasury Wine Estates is wide open. In terms of the beer business, the usual suspects have been named. SAB Miller keeps coming up. I suspect that they might already be running a ruler over this business.
If the demerger is approved, the scheme will be submitted for federal court approval next week.